Hi everyone, welcome to today's webinar, Startup Accounting Essentials, presented by Early Growth Financial Services. My name's Amanda Young and I'll be your moderator today from the EGFS team. And I just have a couple quick things before we get started today. The webinar will last about an hour, which includes some time at the end for questions and answers, but we'll also take questions throughout. So if you have questions about a particular concept or slide, feel free to type your question into the control panel and I'll jump in when I can in order to ask our two presenters, Sirk and Alaa, those questions. The next thing to note is that this webinar is going to be recorded and it will be sent to all of the registrants within 48 hours. You can also find this recording and all the recordings of the other webinars we've done on our YouTube channel, which is just Early Growth. So now I'd like to tell you just a little bit about Early Growth Financial Services. This is a quote from our CEO, David Ehrenberg, and also a couple of the companies that we have worked with to get them started. So basically, Early Growth is an outsourced finance and accounting firm. We work with early stage companies, helping them with everything from their day-to-day accounting to financial forecasts to taxes and valuations. So pretty much anything you would need financially, we can help you with. So now, without further ado, I would like to introduce you to today's presenters, Alaa, Ismail, and Sirk, who will tell you a little bit about themselves.
Okay, since I'm on the left-hand side of the screen, so I'll start hello everyone, my name is Alaa Ismail. I'm a consulting CFO at Early Growth, and I've been working with startup and middle-sized companies ever since the 2001, 2002. I've run the gamut of the type of companies that I've worked with, from SaaS to e-commerce to MarTech, and pretty much all the kind of technology companies here in Silicon Valley, and I'm based here in San Francisco.
Hi everyone, this is Sirk, and along with Alaa, I've been here with Early Growth for quite a few years now, and prior to that, had worked here in Silicon Valley, working with startup tech companies in the software space, in the SaaS space, and hardware. And so I've also worked with different types of companies at different stages of their growth, and I have had the pleasure of being a consulting CFO here with Early Growth, where we get to work with a lot of different types of companies at different stages of the game. And as Amanda mentioned, we work here in the Bay Area. When we say small and medium-sized companies, it's typically tech startups, but we also do work with other types of early stage and smaller companies that don't need to be hiring people full time in their accounting department. So happy to be along on this webinar, and we hope you find this to be valuable to you. So let's go ahead and get started. And today we're going to be talking about startup accounting, and we'll be talking about what we need to be doing at different stages, as we kind of start the company and as we kind of grow through the early stages of the company. And so before the first step is obviously before we get funded, which means that we're kind of at the stage where the company is just getting going. The founders may be, either putting in a little bit of their own capital, maybe a little bit of friends and family money coming in. Maybe you're just kind of bootstrapping along and using kind of revenue that's being generated along the way to help fund the company. But this is at the stage where we really haven't raised money from the outside, meaning that we haven't raised money from either VCs or angel investors to really get the company going. And so we're kind of at the very early stages. And at this stage of the game, basically what you want to be doing is, Amanda, if you could go ahead to the next slide, So, here we just kind of want to make sure that we're getting kind of the foundation up and going, right? And so the very, very first thing that we want to be doing, obviously, is setting up a bank account or bank accounts for the business itself. And the critical thing here really is to just make sure that we're doing one thing, which is that we're segregating our business expenses and all the transactions that are associated with a business away from our personal expenses. So a lot of founders, the easiest thing to do is to say, hey, listen, I'm just kind of getting going here. I've got a few little expenses. I don't necessarily, want to go through the hassle of setting up a separate account. And so we end up, using our personal checking account and personal credit cards, for transactions. And this is kind of where we want to be a little bit careful here. For a couple of different reasons, and we really, really encourage you to, at least as soon as you get started up, you really want to set up a separate account. And there's two reasons for that. One is that from an audit perspective and making sure that we're accounting for all the transactions correctly, having it flow through one account is obviously a lot easier, and after the fact, it's very, very difficult to go back and try to recreate what happened for the business versus personal if we have all the transactions or lots of transactions going through a single account. And secondly, more importantly, is something that we call just kind of setting up a wall right between your personal expenses and your corporate expenses. One of the reasons that you'll be setting up your company, and the way that you do it is going to depend on kind of the type of company, but most startups will be setting up a company as a corporation. And one of the reasons you do that is so that you can segregate out your corporate liabilities versus your personal liabilities. If you set up a corporation, then basically, all the liabilities that's associated with that corporation stops there. And if something happens along the way, whether the company gets sued or we run out of money and creditors come after us, then if we have a complete segregation between personal and corporate, then the kind of the liability stops at the corporate level. If you commingle your expenses and your transactions between your corporate business corporate account and your personal account, then there can be a case made from a legalese standpoint that that you really haven't segregated the two, and there's a potential that the liabilities of the corporation may kind of flow into your personal liabilities. And so for that reason, just from a risk standpoint, it really, really is very, very important that you set up a separate business account. And likewise on the credit card, it makes more sense for us to just go ahead and try to get a business credit card set up as well as your personal, again, just to segregate out all transactions associated with a company versus your personal transactions. And the next slide is really just, making sure that, this is, just from a slide set, that this is really, really something that we point out as being really, really critical, that we want to do those things and set up separate personal and business accounts.
Sirk, also one of the reasons of doing this is when you get funded, I've seen instances where the founders get reimbursed from the funded proceeds for some of their startup expenses. This allows you very easily to justify those expenses and download it into some kind of an accounting software once that is created very easily.
Yeah, that's a great point, Alaa. Part of this is kind of looking forward, right? So it's not just about what you're doing now and what's easy now, but it's also about making sure that you have all the information intact for things like this, right? Things like to the extent that we can use financing in the future to help cover some of our startup costs. We've got the audit trail for that. Similarly, as we start, as we think about kind of how we're going to report things when we do get financing, external financing, then we've already got kind of things already set up in place, so that it's a relatively easy transition, to some sort of an accounting software, which we'll be using to report, what's happening with our business to investors and to other board members. Okay, so from a record-keeping standpoint, at this point, right, it's you're focused on probably a couple of things, right? You're focused on if you're developing products, some software, a SaaS, whatever it may be. You're focused on product development, and you're focused on trying to get customers, right? Trying to get revenue in the door. And to that point, there's just you just want to keep track of several things. Obviously, from a cash standpoint. You want to keep track of where the money's going, what you're spending money on. To the extent that we have customers, you want to obviously set up a system such that we are collecting payments, whether that's through some sort of an online service like Stripe, or whether it's through some sort of a billing process where we bill customers for our product or service. We want to obviously make sure that we are collecting payments on a timely basis. To the extent that we start having employees, whether we're paying ourselves or whether we actually are, thinking about and starting to hire people for the company, then this is a place where you really want to get set up with some sort of a payroll service or HR provider. Such that we're making sure that we are collecting, reporting, and paying our employee and employer taxes properly. This is really critical. Some people try to do this on their own, using just kind of a spreadsheet and kind of making calculations and reporting, thinking that we're saving ourselves money. But this is probably one area where it's very, very easy to be penny wise and pound foolish. The potential for making errors doing payroll on our own is pretty great, and the penalties can be pretty substantial. The cost of actually hiring some sort of an online payroll service provider like Gusto or something like that is very, very inexpensive compared to what they actually do, and the risk that's mitigated by using this kind of a service as opposed to doing it ourselves. And then at this point, to the extent that we have stock, there's it's probably only just one class of stock. We've got some common shares that the founders have for themselves, and we may have a pool of stock that's available for giving out to employees and or advisors, and so it should be relatively simple cap table without multiple classes of stock, such as preferred stock. But we just want to make sure at this point that we're staying on top of it. We know how many shares are authorized. We know how many shares have been issued, how many is outstanding. But we just want to make sure that we're staying on top of this. Our legal team, as we kind of set up the company, will be providing some of this information. But we just want to make sure that we stay on top of this and know what our cap table looks like. Okay, and then obviously from an expenses, this is probably where the bulk of our kind of transactional data is going to be, because we're at this stage we're probably spending more money than we're taking in terms of revenue. We do need to keep records of it. If at any point in time, we know that this is going to be something that where you're going to be raising money on, we're going to want to, probably set up, an accounting system, something like an Intuit QuickBooks is kind of a standard, startup or early stage company type of service that we want to use. But whatever we use, we want to make sure that we're keeping track of the invoices. We're logging them correctly. We're keeping, we have copies of our receipts for later on when we're entering it into the system, for when we're reporting our financials. We want to just make sure that we're keeping track of it. And to the extent that, we have kind of expenses that we need to be, that we're incurring, that's going into our books, that the IRS requires documentation for any expenses that are $75 and greater.
So, Sirk, the one item here on the invoices that a lot of folks sometimes don't realize is that credit card transaction summary is not considered a receipt if you ever get audited by any kind of an entity. So it's important that you start keeping your invoices separate, and the credit card statement does not necessarily um, uh, take the place of an original invoice.
That's right, and so to Ala's point, you do want to keep track of those all those receipts, and have that as backup, so that when you do go to enter all the transactions into an accounting software, and to the extent that we're doing tax returns, and financial reporting, that we have all of that as backup, as physical backup for the expenses, and we're able to justify all the numbers that are going into our financials and tax returns. Good point, Alaa. And then on the cap table, we kind of touched upon the light at a high level. At this stage of the game, it's going to be relatively straightforward. There's probably just some common stock. Like I said, you want to keep track of who's on that cap table, right? So which are the founders? How many shares do they have? Have we given out additional shares for advisors or consultants that that we're paying? That were compensating via equity versus cash. We need to keep track of all of that at an individual owners or stakeholders perspective, so that when we go to report what our cap table and our equity looks like, we have all the backup for that. This is the stage where we want to make sure that we keep this really tight, because as we go forward, as we go into rounds of financing, preferred rounds of financing, the cap table is going to get pretty complicated, and we don't want to be in a position where we have to go back and try to recreate things, in anticipation of a financing that'll just make the fundraising be a little bit more complicated than it needs to be.
One point here on the cap table, especially in the early stages of companies where cash is tight, a lot of founders to get consulting services or advisory services give out stock in lieu of payment. And a lot of times these transactions tend to be forgotten. A great example, you have an engineer that wants to do a certain part of your product, and you say, hey, you're a good friend, I'm going to give you X thousand shares of stock in the company, and if you do this for me, the service gets performed, a year goes by, and now you've raised money, and that person comes back and says, you promised me X thousand shares of your company, and the memory tends to kind of fade, and maybe the amounts don't agree. So getting everything documented and on a cap table, whether it's a simple Excel spreadsheet or a formal agreement that a lawyer might help you with, but something that is going to become very valuable for you later on, because these kind of things could really delay a funding or come back to bite you at a later stage.
Yeah, thanks, Alaa.
Sorry, to jump in here, we have a couple questions about receipt keeping. A couple people want to know if photos of receipts are okay to keep, or PDFs rather than a hard copy, and also how long do they need to keep receipts or records for audit purposes?
Well, the photographs or PDFs of receipts are absolutely fine. That's what we actually recommend. We're big believers now in kind of going paperless to the extent possible. It's great to keep all of our records like that in some sort of a document repository, as a means of going back and being able to retrieve that information. So we definitely recommend that. Alaa, do you know about the kind of the audit requirements and how long we're supposed to keep that data? Like I said, once we actually have that in the cloud, I don't think there's any reason that you would actually you'd want to destroy it in the future. It's just kind of there. Physical receipts, I'm not sure that there's that much value in keeping those versus PDFs of them.
Right. Yeah, 7 years for typical taxes is a minimum that you should keep. I think that's the extent of when the IRS or any kind of taxing authority could go back is 7 years. For payroll records, I would actually keep those indefinitely. Just and please, even if you hire a payroll company, please make sure that you keep all of your payroll records, your quarterly tax returns, your W-4s, all the different things. Keep those scanned and keep those indefinitely. We've seen instances where payroll services go out of business. And those records are hard to retrieve, and then an individual comes back to you and saying, hey, I got audited from 10 years ago and I need my W-2 copy from you, or something like that, or a taxing authority. But in general, 7 years for typical expenses and is a good time frame for you. And one other thing is we really strongly believe in a service called Bill.com. There are several out there, but if you utilize that, it integrates with the financial packages like QuickBooks very easily, and it essentially creates a repository for all your invoices in the cloud, and makes it really, really easy for you to keep invoices. Having your vendors electronically send you PDF copies of invoices, and then matching that with the related payments in your system becomes a really useful tool in the event of an audit.
Fantastic.
There's one more question before we move along to the next slide, if that's all right with you guys. When a startup attaches two different vehicles in the same category, is it okay to have, per se, a franchise under a separate round?
I'm not sure. Could you repeat that question, Amanda?
Yeah. When a startup attaches two different vehicles in the same category, is it okay to have, per se, a franchise under a separate round? Oh, verticals, not vehicles. He just clarified.
I'm not sure what I apologize. I'm not sure what the actual question is. Do you understand what is being asked, Alaa?
I'm not sure, and I'm guessing. I'll have to guess, and that essentially a different maybe a different product line or a different.
Yeah, do you need more than one book for each more than one accounting book for each franchise?
I see. So, for example, if you keep, let me kind of, from an accounting purposes, your filing should be under your Fed ID number. So to the extent that you have several business lines or several entities, if you have one Fed ID number, you'll need to consolidate your financials under that. Now, if you want to keep 10, 15, 20 different verticals under that Fed ID, by all means, that's your prerogative, or whatever makes it easy for you to track your business and operations. From a reporting purposes, from a tax reporting purpose, you'll need to file under a consolidated financial under that federal ID number, unless, of course, you're creating a different entity with a different Fed ID for the verticals that you just mentioned. You will then have to file multiple returns. But if I'm understanding the question, that different verticals or different business enterprises under the same entity, yeah, absolutely, you could have multiple financial systems that track those transactions.
And if you're doing that, at this stage of the game, and you're going to have multiple companies like that all reporting under the same Fed ID number, as Alaa mentioned, software like QuickBooks allows you to do that within the system. You could set up something called classes, for example, which you're able to enter information into QuickBooks, kind of almost as separate business entities, but have it roll up into just a one consolidated set of financials. So there's multiple ways of doing it. Definitely encourage you. To the extent that you have these kinds of questions, definitely talk with an accountant, talk with your legal team as to the best way of setting up the company to maximize your tax structure or reporting structure, whatever may make sense for you. Okay, and then the final thing on the pre-funding, this is just from a compliance perspective, you want to make sure that you're taking care of these things, right? You want to make sure that your state and federal taxes are up to date, that you're reporting them on a timely basis, and that you're paying the fees that are due. And so you definitely want to work in this case with some sort of a professional tax preparer to assist you with this. There's obviously tons of online calendars where you can kind of go and figure out what needs to be reported and paid on a quarterly and annual basis. So we definitely encourage you to do that. You want to make sure that you're registering your business and getting all your licenses, whether they're local, whether they're state, municipality. Just check where you're going to be doing business, what needs to be filed and recorded, and make sure that you're staying on top of that. And then to the extent that you're setting yourself up as a C corporation, you're going to want to make sure that whether it's a Delaware company, Delaware C corp, or other jurisdiction, you're going to want to make sure that you're reporting those on a timely basis. For Delaware, this requires an annual filing, annual report, along with a small fee. And in different states, there's different filing requirements. So you just want to make sure that you're staying on top of that as well. And maybe we can have Alaa talk about some of the fundraising prep.
Okay, this is just a general slide. Next slide, please, Amanda. So when you're getting ready to raise a round, there's several things that you'll need to prepare. Of course, the number one thing is the pitch deck, and we'll kind of briefly scan over the items within a pitch deck. We give actually another webinar with a little bit more details on that, so we're not going to get into a lot of fine points on the pitch deck, but please make sure that that's ready. Have an executive summary, because a lot of times when raising money, you're not going to have the opportunity to actually do your full-on pitch in front of a potential investor. So an executive summary or an elevator pitch, have that ready. In instances, a lot of times the fundraising does not take place in a formal setting. Fundraising could be in a networking event where you're meeting somebody or potential investor, and you want to be able to have your elevator pitch and an executive summary kind of in your mind, so you could talk that through. So we'll be going over some of those, some of the items required for getting you ready to fundraise. Next slide. The one thing on the financials, the bulk of the investors out there want your financials to be prepared using generally accepted accounting principles. So generally accepted accounting principle is generally a accrual-based financials as opposed to a cash-based financials. And accrual basis is very kind of simply remembered as you recognize your revenue when you earn it as opposed to when you collect it. And you recognize expenses when they're incurred as opposed to when they're paid. Cash accounting is really the other way around. You recognize the revenue when you receive it, or the cash is received, and you recognize expenses when you pay it, when you physically send out a payment for it. So that is the accepted method that you should use for your financials. is generally accepted accounting principles or the accrual method. A lot of companies in the pre-funding or a lot of founders in a pre-funding stage, of course, do things on a cash basis because that's really the intuitive way that you kind of recognize your expenses and revenue. But prior to going into a funding round, please convert your financials into a GAAP-based financials or accrual-based financials. I have not seen many investors out there, especially institutional investors, that are okay with non-GAAP financials. It'll make you look a lot more professional. And so if you are on a cash basis and you're getting ready to fundraise, spend some time and go to an accounting consultant and convert your financials to GAAP basis. Next slide, please. So here are kind of the elements of a pitch deck. The one thing that that we really stress to folks is that, you know, keep your pitch deck concise. If you look at this presentation, you've got maybe 10 slides or 12 slides at the very most. You know, encapsulating things like your mission statement, the problem or solution that you're trying to resolve, your secret sauce, your technology, you know, getting into that. Of course, your financials, and we'll get into the financial components after this. But this slide kind of gives you an idea of the elements of your pitch deck. Again, here, if you have not done one in the past, it's really important to get some help on that and make sure that you involve all the principals in your organization in forming this pitch deck, because this is your chance to shine. And if the more that your pitch is refined, the better your investors are going to you know, hear your message and be able to focus the fundraising in the proper way. So we give presentations on that, and there's a lot of folks out there that could help in a pitch deck. So getting help and making sure that you present yourself professionally is really critical. Next slide, please. So the funding financials is where we'll spend. Typically, financial statements in a pitch deck, they want to cover where you've been, meaning that if you have actual financials or if you've been in operations for a while, they want to see those results. And the financials, they also want to see projections. I typically like to give, you know, any kind of historical financials plus 3 years of forecast. So 1 year being, you know, a detailed forecast, or as we'll get into, a bottom up, and another year is kind of more of a top down or a forecast that is kind of more of a projection. It's something that is a little different than a bottom up, and we'll go into some of the differences in the upcoming slide. But typically the financials that you present are an income statement that is 1 year bottom up and for the forecast, and the other year top down, and also the related balance sheet and statement of cash flow. Next slide, please. So a top-down projection is essentially how it sounds. It's not really useful for operations, meaning that a top-down projection is not something that you'll use with your team to run the business. It doesn't have that sufficient detail, and it is not as thought out. But it will give a prospective reader of how you feel that the company will do in a period kind of down the line. And a lot of times I recommend to my companies to start out with a top-down forecast and then go into a more finer detail to get into your bottom-up. So the elements of a top-down, for example, in a revenue, instead of taking a very detailed pipeline projection for your revenue forecast, you might start with a market size, saying that the size that you're the market size that you're going to address is $10 million. And you plan on serving a particular segment of that market. Or it could be if you're a SaaS company, it could be based on a number of clicks that you expect to get, or a number of views to your website that you expect to get, and the conversion of those clicks. But it's a very, very general. It's not based on a lot of detail. It's kind of like a global vision of where your revenue is going to be. On the expense side, it could be as simple as percentage calculations for things like sales and marketing, engineering expenses, and G&A. One of the things you can do, especially if you don't have a lot of detail information, you could look at similar companies in your segment and say that, they, in a startup phase, they typically spend 30, 40, 50% on engineering, or 10, 20, 30% on sales and marketing. But it's not detailed. It's not based on headcount analysis. It's not based on consulting projections. It's a very, very high level view of where you think you're going to be in the future. Next slide, please. Bottom up is really the forecast that you want to use for operations. So for example, on a revenue bottom up projection, you might want to look at a pipeline. Here are the customers that that are currently in our pipeline. Here's the stage that those customers are at. Here's the likelihood that these deals are going to close. It could be based on number of sales reps. Each sales rep has a quota of X amount, and we expect that each sales rep is going to be meeting 80% of that quota. It could be based on historical numbers. If you're a SaaS company, saying historically, we've had X number of views on our website, and the conversion rate is Y, and this is how we're basing our revenue. So the revenue projection is very detailed, and it's based on real information. On the spending side, a bottom-up projection, the biggest cost element is usually your headcount. So it will be based on the hiring that you're planning to do, and the existing employees that you have. I'm going to hire a QA engineer in July, and the annual salary for that person is $90,000, and so you would schedule that out in a bottom-up projection in real time by month. Consulting costs is another big element for startups. So you would schedule, when you're going to hire the consultants, and you get granular on that. The different types of consultants and the various times that you're going to hire them. For general administrative expenses, you would include specific things like rent and all the facilities charges, your professional fees, your accounting, legal. So there's quite a bit that you would want to include in your bottom-up forecast. To the extent that you have history, that will be very, very informative. So getting an accounting system early on in your enterprise will really help you with those forecasts. To the extent that you do not have that history, it's important for you to maybe consult with somebody, a financial expert, somebody like a service like Early Growth, that could help guide you in your bottom-up forecast, so you're not missing anything. The one final thing in a bottom-up projection is keep in mind GAAP rules too, so that you're recognizing revenue when it's incurred, or when it's earned, and expenses when they're incurred, and make sure that your financials, your bottom-up forecast and your top-down forecast takes that into consideration. That's specifically important for things like cash flow projections and And investors really will want to see that as well. Next slide, please. So in the post-funding stage, if you go right to the next slide, I think, Sirk, are you going to be taking this part?
Sure, absolutely. Thanks, Alaa. So when we say post-funding, this means that you've raised some funds from the outside. It may be institutional investors, it may be angel investors, it may be a significant amount from friends and family, whatever it may be. But you now have investors that you need to be reporting to. It's not just yourself and your credit card account and your bank account, but now you have outside investors that you need to be reporting to. And at this stage, basically, we need to actually set up a reporting structure that reports, obviously, what happened with the business. And to Ala's point earlier, by this stage, you should have already set up your accounting system such that you are recognizing your financials using generally accepted accounting principles, which typically means that they're accrual based, no longer just cash based. And that you're reporting your financials to your investors in the format that they would expect. And so to that point, there's three main financial statements which all tie together, which when investors look at the combination of those three, that they'll get a real good sense as to kind of where the company's at from a financial perspective. And that is the income statement, the balance sheet, and the cash flow statement. Here is a sample of this is as simple as it gets, but basically an income statement which says that this is how much our revenues were, this is how much expenses that were incurred in generating that revenue, which gets us to a bottom line of a net income or a net loss for the period. And typically, you'll kind of be reporting this, in like a monthly format, quarterly format, whatever makes the most sense to report to for investors. So if we go to the next slide, and actually this next slide probably should have been the first slide, but this is a chart of accounts. So you're going to want to set up, these are all of the accounts that you're going to be setting up in your accounting software. By now we'll touching on accounting software. Let's say you're using QuickBooks, which is probably again the most widely used accounting software for early stage companies. But these are all the accounts that you're going to be setting up, to track your revenue, and you may have different types of revenue streams, and you want to track those separately. Same thing with cost of goods sold, same thing with expenses. And how you set up these accounts are going to depend on your business and what makes the most sense to report, separately, right? Does it make sense to set up different departments at this stage? Do we want to track expenses by department, or do we want to track expenses by type of expense? Those are the kinds of things that you need to consider and what makes most sense for your company. The chart of accounts will also set up all of your balance sheet accounts so that you can see what's happening, on your assets and your liabilities and equity. But that's kind of, as you're setting up these chart of accounts, all of these accounts are going to be used to report your financials. And the nice thing about something like QuickBooks is, you can just kind of start with a very, very simple chart of accounts, and you can add to the chart of accounts as your company grows and as your needs grow from a reporting perspective. The next slide is a second slide, or second financials that you'll be reporting, and that's the balance sheet. And as the name implies, this is basically what your financials look like at a point in time, and it reports your assets, your liabilities, and your equity. And again, as the name implies, that these need to balance out, right? So the assets have to equal your liabilities plus your stockholders' equity. And so this gives a reader an understanding of what we have. What do we own, which is what we have in terms of assets. This can be your cash, the amount that's owed to you in accounts receivable, any type of inventories or fixed assets, land. It could be prepaid assets. There's a whole host of things that that we own that have value to our company. And that would be reported as an asset. Likewise, you also have liabilities, things that we owe, accounts payable, other types of expenses that we've accrued for, that we, if we were to shut down the company, that we would owe these amounts, and that needs to be reported on your balance sheet. And then finally, your stockholders' equity, which is kind of the remaining amount, right? So the difference between the assets and your liabilities is what's going to be held in your stockholders' equity. And there's not only the stock, the value of the stock that you own in the company, but this is also where retained earnings, or kind of like a culmination of all your gains and your losses that have been reported. This shows up under retained earnings and kind of helps tie the balance sheet together with the P&L or the income statement. And then finally, there is the statement of cash flows. And this is kind of I'd say this is more of like a precipitate of your income statement and your balance sheet. And what this shows, it starts with kind of your operating activities, and what happened, from what happened to your cash, right, from operations. So this, kind of, it's a little bit complicated to explain, but it really kind of, tells what happened. It ties the income statement and what happened with the balance sheet to really equate what happened with the cash. So, for example, if in a given period, from an accrual perspective, we had a net loss or net income of $10,000, and that will show up as kind of the cash, the starting with the income statement, your net income, and then you make adjustments to that based upon kind of other things that affected cash, but not necessarily your income statement. And this kind of ties all that together. This probably isn't the place to kind of go into the kind of the nuts and bolts of how this works. I think from a financial accounting perspective, there's probably another full hour that we could spend in terms of how all this stuff ties together. But just as an introduction, these are the three main financial statements that you're going to be looking at and presenting to your investors on a monthly or quarterly basis.
So the one item I'd like to kind of, on the statement of cash flow, this is for especially new entrepreneurs. This is where I spend a lot of my time with reviewing the financials with the entrepreneur, because cash basis is where a lot of folks that don't have an accounting background kind of understand their operation, and they're usually very intimate with that. So a statement of cash flow is a reconciliation of a GAAP basis or accrual basis income statement with the actual cash activity. So we usually spend a lot of time with the new entrepreneur and kind of on a cash flow statement. And one final point before we get off of financial statements, there's a tendency, especially early on in a lot of organizations, to kind of have the accounting function as kind of something in the background, and not as long as I'm paying my bills and collecting my revenue, I'm okay for now. I want to focus on building my product and getting to the next stage. But please don't let the accounting and the financial statements kind of get stale and place some importance, because I've seen a lot of organizations where accounting slips, and then at some point in time they're forced to present some kind of financials, whether it's in due diligence or acquisitions or, God forbid, a tax audit, and they find it to be very expensive and very painful. And that's the issue with a lot of financial statements, is that if you keep up with it ratably, it's actually a very simple task and usually doesn't take a lot of time in a simple organization. But if you kind of come back and have to redo 2 or 3 years worth of financial statements, it becomes very time consuming, expensive, and painful. So kind of keeping current with your financial statements is really good advice very early.
Couldn't agree more with that, Alaa.
Yeah.
Okay, and then this one will be near and dear to all entrepreneurs' hearts. Cash burn, right? So this is something that you have to know what's happening with your cash. How much are we spending per month? To the extent that we're still in a kind of a cash burn stage, which a lot of early stage companies are, they're spending more money than they're bringing in terms of revenue. And we always have to know how much cash are we burning, and how much cash do we have, and what is our runway or time to live, right? So, based upon the current rate of expenditures, how long will our cash last us, right? So this is a number that you have to have at the tip of your tongue, forefront of your mind. Anytime you talk with investors, whether they're current investors or potential investors in the future, they're going to want to know that information. To the extent that this number changes, right? Let's say we just had an issue where all of a sudden we had to expend more money than we thought we were going to, and all of a sudden our expenditures have spiked, and this impacts our time to live. We need to understand that as quickly as possible, and then to the extent that we need to be communicating that to the outside, whether it's investors or to banks, lenders, whoever it is, we want to be doing that proactively as opposed to retroactively and saying, oops, we messed up. We thought we had 12 months of cash. Now we're only down to 8 months of cash. That's a message you don't want to have with investors, after the fact. And then we'll spend the last 10 minutes here really quickly going through other things that you need to be doing now that you've been funded, and things that you need to stay on top of. Budgeting and financial planning. This is we've already probably put together for fundraising purposes this 3 to 5 year plan. That is both a combination of tops down and bottoms up, as Alaa so eloquently stated. You're going to want to keep this up, right? You're going to want to budget, and you're going to want to plan your financials, your spending, your revenue projections. Now we're kind of getting into the nitty gritty. You're going to want to do a bottoms up financial plan, which really allows us to operate our company based upon kind of what we're trying to achieve and the resources we're going to need to achieve it. And so now we're really getting into understanding our business, understanding our operations, and being able to put that on paper. To do this, you're going to want to obviously identify key variables. And in most cases, I always tell people, look, you can make a financial model say whatever you want, right? And because it's all about just kind of putting together formulas. But usually there's like a handful, 5, 10, maybe key variables that really drive the financial planning process and the budgeting process. And so understanding what those levers are and understanding how we can manipulate and really plan for these key variables will really drive our model. And we need to always be keeping on top of those variables, seeing how we're doing, go back on a monthly or quarterly basis at an absolute minimum, and look back and see, okay, how did we do compared to what we said we were going to do this past quarter? What assumptions should we be making? Does this have an impact on our long-term cash flow planning? Does this have an impact on our runway? How are we doing, and do we need to be making changes to our plan? We always recommend doing different scenarios. So we're big believers in having a model that allows us to run different scenarios. Typically, it's an expected case, a worst case, and a best case scenario, so that we kind of understand what the upper boundary and the lower boundary of what we can expect to have, and being able to be able to make adjustments along the way depending on how we're doing compared to those different scenarios. Next slide. We talk about at this point we should be setting up internal controls. So who has access to financials and funds? Typically this is the founders. And then to the extent that there are executives that need to be seeing these financials, then obviously we want to we want to make sure that the right people are getting access to these. The internal controls, this is one where you want to make, just at this point now, there's segregation of duties. You really want to set it up so that one person is actually printing checks, another one is signing. You don't want to have it set up so that one person is able to do all of this, right? And it's not that we don't trust people. It's just that you just want to set up proper controls now so that there aren't any as you continue to grow that these don't become issues. And quite frankly, the best approach you want to take is to have someone actually enter the transactions into QuickBooks or their accounting software. Then you want to have another person reviewing it and printing the checks, and then the final person signing it. So that is kind of the optimal way of doing it. But at the absolute minimum, you want to make sure that there's a different person that are signing checks versus the one who's actually printing and preparing the checks. Accounting system, we've talked about this, right? So by this stage, if you haven't set up an accounting system, if you're using an Excel spreadsheet, to keep track of things, you're probably already past the stage when you should have set up an accounting system. If you haven't done so, you want to do it now. Like I said, we highly recommend QuickBooks. It's a very, very robust online system that allows you to have access, that allows outside accountants like Early Growth to have access. Definitely recommend it. And also just QuickBooks Online is a system that basically everyone knows. I don't know of many companies at this stage of the game that would benefit from something more robust or less than what QuickBooks Online gives you. There's other systems like Xero is another system that's popular, and you can go with that. But we've always found that QuickBooks Online is probably the best. You want to make sure that you are keeping track of accounts payable, expense reporting. All I mentioned Bill.com from an accounts payable perspective, and even accounts receivable. You can use Bill.com to not only record the bills coming in, but also all the bills that are going out to our customers, and keeping track of it that way. We highly recommend that. The expense reporting, we want to, again, to the extent that there are employees who are reporting expenses, we want to make sure that we're recording those properly. There's systems such as Expensify, which is a great system to allow employees to do that. We encourage you to look at systems like that to make it very, very simple for employees as well as for yourselves from a reporting perspective. And obviously payroll, you want to make sure that payroll is being done properly, being recorded properly, that payroll taxes are being set aside properly and being reported and paid to the correct services. And then finally, just one final thing, valuations. If you are giving stock options to employees, you need to be valuing the company so that you are pricing or valuing the common stock or the stock that you're giving to, stock options that you're giving to employees at a fair market value. If you don't do this, then you can run into securities issues, big pain in the butt, for yourselves, for the employees that are getting the stock options. This has to be done at a minimum on an annual basis, and then also whenever there's any kind of a big change that might impact the value of a company. So at an early stage, that typically coincides with a round of financing. So if we raise a round of financing, after that is done or concurrent with that, we should be doing a valuation of the company. I think what you'll see if you do some research, typically they're called 409A valuations. And this is something, if you're not familiar with, do a little bit of research, but this needs to be done on a regular basis, and your legal team will provide counsel. There are firms that specialize in this. They need to be objective outside, but they're also you should be working with them, and they should be open to working with you to set a fair valuation of the company, such that you're able to kind of optimize the stock options that you're able to give that provide value to the employees who are receiving them.
Thanks, Sirk. So I know we're running a little bit long here, but if you don't mind, I do have a couple questions we can run through really quickly before we sign off. So if you have a multiple verticals, do you need a separate business plan and workbook with EBITDA for each vertical?
Yeah, EBITDA. Yeah. So again, it just kind of depends on your company. So EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization. This is kind of what what accountants and investors will look at in terms of the actual cash that's being thrown off by the company, how much cash is required over a certain period of time, and is kind of a means of value, or not valuing, but really trying to understand what's going to happen with a business over a certain period of time. Whether you do that separately for each vertical or subsidiary, or whether you do that as a whole, again, it's kind of similar to the answer that Alaa gave as to whether you need to be setting up different accounting systems to track them separately. It's just going to depend. If they're different subsidiaries, for example, and there are different types of products that roll up into a holding company or a high-level company, then yeah, I would probably suggest that you would probably want to do different planning for those. If they are different franchises, for example, and you're just talking about like different locations and should you run different models for each different type of location, I would probably say no, you don't have to do that. You kind of need to just roll them up, using classes within QuickBooks, and do planning kind of at that level, and that probably makes more sense and make it easier for you from a reporting and tax perspective. And finally, it really comes down to what you think investors are going to want to see. Potential investors, right? Are they going to want to look at these business lines separately? Are you reporting, or are you trying to raise money, using these different verticals? If so, you're going to want to separate them out. If you're trying to fundraise at a holistic level, at the top level, then it probably makes more sense to kind of combine your verticals into one set of financial plans.
Great. It looks like we are all set in terms of questions. I'm going to answer one privately offline because I can answer it myself. Other than that, thank you everybody for joining us today, and thank you so much, Sirk. Any final thoughts you'd like to say before we close it out?
Yeah, absolutely. So I want to thank everyone for spending an hour out of, I'm sure, what is your very, very busy schedule. And for all you entrepreneurs out there, who are doing this, kudos to you. We think you're doing fantastic work. It's because of people like you that the startup industry is thriving. Continue, and we wish you the best.
Great, thank you everyone, and I will follow up with an email. If anybody has any other questions, feel free to respond to that email and ask questions, and I'll also include the recording of this webinar so that you can go back and relearn everything we talked about. Thank you all very much. Have a great rest of your day.
Thanks, Amanda. Take care, everyone.